What if we could have guaranteed protection and guaranteed growth? Wouldn't you be psyched about that? You are putting money into a vehicle that allows you to earn uninterrupted compounding interest. And while you're earning uninterrupted compounding interest, what you're also doing is you're allowed to use the money and make a spread. Now, you would be making money twice. This policy is guaranteed to grow every single year. It can do nothing else but be worth more next year and the year after and the year after. Nothing else can do that, folks. This money used to be given away to all the debts. It was gone forever. Now it's all back in their household, back in their family banking system. Welcome back, everybody, to another week, another wealth webinar where we're gonna sit here today and we're gonna teach you and share with you some really amazing strategies. And you know, I got something really special planned for today, and it's really kind of gonna go into the imagination. You know, when you think about the stuff that we teach, which all shows you how to take back control of your money, how to preserve your money and your capital, but also how to grow your money and produce income. So those are the three main topics I want to hit today. Number one, preservation of principal. I can't talk about any other time in history, at least in my life of 47 years, where it's more important to preserve your principal than it is right now. We're at the end of a bunch of cycles, three cycles: short-term debt cycle, long-term debt cycle, technology cycle. All of them are converging in an election year. And, well, I can tell you what's coming, but we'll get into that in a second. So preserve your capital. Number two, I'm going to really start today off with taking back control of your money. Now, I know for a fact a lot of people go through life thinking they're in control of their money, but they are not. So we're going to dissect that first. And the last thing, how to grow your money and produce an income while preserving your principal, while taking back control. So that's going to be the agenda today. Stephen, is there anything else you wanted to get out before we get this thing kicked off?
No, just like, well, good afternoon, good morning, West Coasters, and looking forward today. We got so much important stuff to share, so dive right in.
All right. So listen, one thing that I see a lot of is I see a lot of people, especially right now, that have equity in their homes. If you've got equity in your house, or you think you have equity in your house, put it in the chat right now. Now, I know a lot of you might say, yes, I do, but you know, here's another thing it might not be a bad idea to do. If you haven't done this yet, go to your local credit union, your local community bank, or whatever bank you bank with, and go in and just inquire about getting a home equity line of credit. There are a whole bunch of credit unions nationwide right now that are doing intro rates on home equity lines of credit. And the reason I want to start with this is a lot of people are literally one step away from being able to start changing their financial life. And that step away is tapping into the equity in your house. I mean, listen, it's no secret. Over the last 10 years, actually for a longer period of time, but the last 10 years has been pretty nutty. Real estate values have gone up, up, and up, and up really steeply in the last couple of years after the pandemic. And that's primarily because of demand and just a lot of other things. During the pandemic, a lot of people saved a lot of money. They wanted to upgrade their homes, but then interest rates got really high and it slowed it down. But the demand is still there, make no ways about it. But the beauty about that is if you've got a house, there's a strong probability that you have equity in your house, right? So look at all the people that just commented. We got Fern, Sonia, Nathan, and there's a whole bunch more that said they have equity in their house. And I love that somebody just mentioned Navy credit unions. So the Navy Federal credit unions, they're all over the place. That's a great place to start. Intro rates. So I just got a home equity line of credit on my house. Okay, I had it on my mom's house, and I talk about that all the time, but I just got it on my house, and I got an intro rate of 3.99. And the reason I'm sharing this is I just want all of you to go out and see if you can do that. If you don't, well, here, let me check this. We got a bunch of people, and we got a lot more coming in. So there's 70 on here. We're used to having like 150, but we know it's summertime. How many of you right now have a home that has equity that you do not have a home equity line of credit? Put no in the chat. I just want to see how many of you don't have a home equity line of credit on your house. Perfect. I love that. And there's no right or wrong as to why you do or why you don't. Now, let me ask, how many of you do have a home equity line of credit on your house? Put yes in the chat. Because what I'm going to show you is going to apply to both of you. I got to change this screen share. I got a new board here. All right. So we got a bunch of you that do not have, and we have a bunch that do. That's perfect. How many of you are actually using your home equity line of credit to build more wealth? Put more in the chat. Okay, Drew is. Awesome. Greg is. So we got a couple of you. Now, here's one thing that will keep every single household, every single individual from reaching their financial goals, and that is debt. It always has been and it always will be debt. And I know for a fact, now I don't know each of your situations, but I know for a fact in this country right now, there is more debt than there's ever been. Credit card debts are literally peaking, setting records. Now, that's not something to be proud of, especially when you consider the average credit card has a rate, an interest rate on the money you use for the credit card of over 20%. I mean, that's usury if you, it's not, but you know, it is. And a lot of the credit cards are 29.99%. I mean, has anyone looked at what your credit card's charging you? They send you all those tiny little things in the mail, or maybe you get the emails and it shows you how much your interest rate is, but interest rates have gone up a lot on credit cards. 20 to 29% is the average now. Now, it never used to be. I mean, I remember just, Stephen, you and I, we were doing these trainings not long ago and doing live events not long ago when people had 0% credit cards. And a lot of people had credit cards even less, you know, like then they had like 5, 6% on their credit cards. That was when interest rates were low. Interest rates are not low anymore. Now, I know the Fed is going to start dropping rates, or at least I'm got a strong probability to believe that the Fed is going to start dropping rates in September, but we're not going to wait till then. So we're going to take right now where interest rates are, and we're going to play a little game to get rid of debt. And I want to just show you how this works. So first thing you'd have to do is you'd have to find a credit union, a bank, a community bank, and get a home equity line of credit. Almost every time, unless you got a jumbo, like a big mortgage, almost every time, the bank will waive the fees. They will pay for the appraisal because they're going to make their money in interest, and that's what they know. So there's usually not a cost for you to get a home equity line of credit outside of your time. And I want to just check and make sure you all know this. When you get a home equity line of credit, you don't have to use that money. And if you don't use that money, it doesn't cost you anything. You do understand that, right? Because a lot of people will refrain from getting a home equity line because like, I don't need it. Get it. Because when you need it, you won't be able to get it. Does that make sense? Get the home equity line of credit now, because when you actually want it, there's a strong chance you won't be able to get it. You won't be able to get it for a number of reasons, which I'm not going to go into, but number one, banks won't want to be lending. When things deteriorate and the economy goes down and everything starts to fall apart, banks aren't going to want to lend. Right now, they're not lending very easily, but you can get a home equity line of credit. So let's just assume, and I'm just going to use numbers, that you could find a home equity line of credit around 7%. We're just going to use 7% for today, okay? So we're going to use 7% as the interest rate that you can go out and get a home equity line of credit. Now, I'm just going to give you an example, and I just want to show you how this works. If you've got a home equity line or you're going to get one, this is how it could work. Over here, I just did some sample debts, right? Your debts will be different than what I'm going to show. I'm just going to give you some examples. Credit card debt of, I don't know, $200 a month is what you're paying at 20%. A line of credit, $100 is what you're paying a month at 9%. Car payment, $500 a month at 5%. Student loan, $250 a month at 3%. Store credit card, $150 a month, 24.99%. I just whipped this up, right? I just kind of came up with these. There's no relevance to that. But right there, if we added that up, I mean, one credit card at $200 a month, people are like, it's only $200 a month. But that, plus the line of credit, plus the car, plus the student loan, plus the store credit card, that's $1,200 a month. How many of you want $1,200 a month to save? Like if you just had a windfall of $1,200 every month that you could save, do one of those specially designed whole lives, invest, whatever you want to do, you'd all like that, right? But here's the thing I look at. When we work with clients and we share this information with our clients, like I am with you right now, one of the things we always point out is when you look at the interest rate, people will look at interest rates differently than we do. We're going to blend them. So if we add up all these interest rates and we were to just get an average, this person in this scenario would be paying 12.39% in interest. That's money leaving their family every single month. $1,200 gone forever at a rate of 12.39. How many of you are getting 12.39% consistently every single year in your 401k? There's always going to be one. We had this one guy come on in the beginning. He was kind of a jerk. I bet you he would say that he's getting 12. But is anyone getting 12.39% interest on their 401k or their investments, stock investments or mutual fund investments on a consistent basis? Right. Brian's like, not in my 401k, but all my private lending I'm doing, I'm getting like 15. I get it. But let's just put it into perspective. So if you're giving away 12.39%, that's where we need to start. Because 12.39% would be an awesome return if it were guaranteed to you, would it not? Like, what if 12.39 was the guaranteed return? You'd all think it's someone clobbered you over the head, you're in heaven. You think something really amazing just happened. But it could be guaranteed. You see, one of the things that we share in our book, Mapping Out the Millionaire Mystery, and all of you should have gotten a copy of this when you signed up for this webinar, is we share this one principle. What if you could get all the money back for every purchase you ever made and create wealth through your own debts and expenses that you already have? It's right on the back of the book. Well, this is just one way to do it, but that book talks about how to do it using specially designed whole life in a process called the infinite banking concept. But you see, just like I said, the infinite banking concept is a process. It doesn't have to be a product, okay? Because we all want to, we've been messing around with AI a little bit. And, when you put in infinite banking, it always talks about the product, the whole life, right? The specially designed and engineered whole life. But what I'm going to show you here is the infinite banking concept. It's a banking process I'm going to show you. And what I'm going to show you is how to take back the banking functions in your life, but I'm not going to use a whole life. I'm going to show you how to do it with the lazy cash that's sitting in your house. So you go out and you get a home equity line of credit. Let's just call it 8% or 7%. Anyone got a 7% home equity line? And I'm not going to use numbers if that's okay. I'm just going to kind of show you the process. What you would do is you'd get this home equity line, and we would then take money from the home equity line. We would move it over, and we would put these debts in order from lowest balance to highest balance. So what we would do is whatever the lowest balance credit card is, that's the one we'd pay off first. So I'm just going to make something up. Let's say the student loan, $250 a month at 3%. Let's pretend that's your lowest balance. We're going to pay that one off first. Now, most people would never do that. They would not pay that one off first because it's only 3% interest. And they would say, but wait a second, I'm paying 7% to use the money and I just paid off a debt for 3%. But it's about the velocity of money here that I'm trying to explain. So if we did that, now what we've got is we've got $250 that we are going to move back over to this side. And this side is the side you want to be on. This is your debts. This is going to be your assets. Now, $200 a month, $250 a month is in your, I'm just going to start adding these up here, okay? $250 a month is now in your savings, which you could use to pay the home equity line of credit. But we're going to keep doing that. And if you had enough in your home equity line, which is usually what we see, most people outside of their primary mortgage have enough equity in their house to pay off almost all their debts, with the exception of their primary mortgage. So let's just say your home equity line of credit had enough money to pay off each of these debts. Let's just do this quick. You pay the credit card off, you pay the line of credit off, you pay the car payment off, you pay the store credit card off. $1,200 a month no longer goes to these outside third-party banks. Now what you've got is you've got $1,200 coming over to this side, and now you get to keep that money. So now we can't keep it all, because what we got to do is we got to figure out, let's just say all these debts were $100,000. Let's just do this real quick. $100,000, that's $7,000 a year divided by 12, $583. So essentially, I'm just using simple math. $100,000. You sent all 100 over here. All these debts were 100,000. You paid them all off, and now that they're all paid off, we have that $1,200 coming back over here. But we got to pay 7% on $100,000, which works out to be 500. Let me get a different color here. And I know for some of you, this is really elementary, really basic stuff. But I wanted to start somewhere, and this is where I wanted to start. $1,200 minus 583. That would mean now you would have an extra $617 every single month. You paid for the home equity line of credit's interest, but you now have an extra $617 a month. So what would you do with that? Well, smart people would take the $617 and they would keep paying off the home equity line of credit. Whatever you do with it, it doesn't matter. But that's $1,200 coming back into your household, of which you only owe $583. And here's probably what's going to happen. Home equity lines of credit, unless they're a fixed rate, which don't do fixed rate, do variable rate now. If you do a variable rate home equity line, chances are this rate is going to go down. It's going to go down because the Fed's going to start dropping rates. And when that rate goes down, you are going to make even bigger spreads. Does everybody understand what I just showed you? It's pretty basic, nothing complicated about that. But I wanted to start there because that is how the process works. And I started with a home equity line because, hey, why not? Now we can get into something more fun. So right there, what we just covered is taking back control of your money. Taking back control of your money is the single most important thing you will do in your lifetime when it comes to your finances, because you cannot get ahead if you constantly give up control. So does everybody understand what I mean by giving up control? So let's just say you go to work and you're worth, I don't know, let's call it $50 an hour, and you make $50. I don't have a 50 here, but I just got a bunch of singles and fives. This is $50 right here, okay? So you got $50 that you made for working 1 hour. What do you do with that $50? Well, you probably have it direct deposited into someone else's bank. Let's just say it's your credit union. So you put the money at the credit union. What is the credit union going to do with that money? Well, they're not going to put that money in the safe with your name on it. They're going to take that money and they're going to lend that money out at a higher interest rate than what they pay you. So if they pay you 1, they're going to lend it out at 5, 6, or 7. And they're going to make a spread. I just showed you how to do exactly the same thing, which is why that's taking back control. But if you keep putting money in the bank and keep borrowing money from the bank, you're constantly going to be giving up control. That's the first thing that's got to change. So what I decided I was going to do, and I was kind of thinking about today's training, and I was thinking, how can I show this the best way? And I said, all right, what if I just show everybody real numbers? Like literally, I just show you real numbers from real policies. And I want to start with the worst kind of, well, not the worst, an IUL would probably be the worst, or a VUL. These are just numbers of a policy that we designed for a client, all right? So these are just the numbers of a policy we designed for a client. And this client was 34 years old. They dumped in $105,000 or $100,000 and $15,000 per year. Get rid of this. But that was the design, all right? So we'll just say this is my policy. $100,000, $15,000 a year. And we did a 60-40 design, which means 60% goes to the PUAs, 40% goes to the whole life policy, which is called the base, which means the advisor who does this, which if it's us, this policy, we are giving up 60% of our commission so that you essentially have 60% more money to use. But I'm going to show you something that a lot of people get confused when they watch a lot of videos. They start thinking, oh, well, if that's the case, then why wouldn't we do 90-10? Why wouldn't we put the most amount of money into the paid up additions and reduce the commission the highest amount we can? And I totally understand that. Okay, so if that were, I'm just trying to, yeah, there we go. If that were the case, we would do that on every policy. But you see here, this client dumped in $100,000. They dumped in $100,000 on this one. That's what I was looking for. I'm trying to get a different color on this thing so that, there we go. Zoom changed it up a bit. $100,000 dumping. And when we dump 100 grand in, we can't do a 90-10 because it would mech. It would become a modified endowment. So we did a 60-40 on this one. And I want to just I just want to show you what this looks like. All right. If we did a 60-40 on this, right there in the first year, we put 115 in and we got 106 that we get to use immediately after the first year. But you could use some of that 106 immediately in the first 30 days. The money's available immediately with the way we design these. But I'm giving you the numbers here, the projected cash value per year at the end of the year when they paid dividends. So over here, if we subtract 106, we subtract the dividend, that would give you a roundabout idea of how much money you'd have immediately in the beginning of the contract or immediately when you start your banking system. So just trying to put it into perspective. But right here, let's just say we took this 106 out and we decided we were going to invest this money in something. What is everybody investing in right now? Anyone got anything good that they're investing in? Anyone got anything good? Mobile home park, somebody had mentioned. Equity line of credit, 70 grand, 8.5%, no debt. Love that. Come on, we got 100 people here. How many, what's everybody investing in? A FedEx franchise, okay. I love that. Myself. Single family homes. All right, Andrew, I'm gonna pick on yours. So, okay, let's take this 106 and you wanted to invest it in a single family home investment. You were gonna rent it or you're gonna flip it. What kind of return you getting on that? Single family home. Then we got Brian who's lending money at 11. Brian, check out privatemoneyclub.com. You can probably be lending around 12 to 15% first lien. Then Lucy said forklifts, real estate notes, love it. Parents Ranch. Yeah, well, there's nothing wrong with that, Troy. But let's try to figure out, like, what kind of returns is everybody getting on these investments that are doing? Getting 10%? I mean, I got 11% up there. So let's just use that 11% because that's the one I got. You got an 11% return. So if we took 106 out, we put in 115, and we could only take 106 out, which means we essentially lost a little, about, I don't know, 5.78%, give or take. So let's round it up to 6%. You lost 6% the first year. That's not good. But that's the nature of the beast. You have to give to get in this. So why did you not have 100% of your money or more than 100%? Because you got a death benefit. The insurance company does charge for this death benefit. Okay, $1.899 million is what this person got in a death benefit, and they got access to 92% of their money. But they also got access to using $106,000 of this money without interrupting the interest and dividend they earn on $115,000. So what does that mean? Well, let me just explain it this way. Right here, you got a death benefit, right? But you got to die to have this death benefit pay out. And that's not fun. That's term insurance, right? You got to die to get the insurance company to pay that $1.89 million. So we don't want to die. I mean, I hope nobody on here wants to die. Lucy's getting 12 to 20%. That's fantastic. All right, but what if we wanted to use some of this death benefit when we're living? Would the insurance company let us do that? How many of you think the insurance company would let you use some of your death benefit while you're living? Anybody that's been around this campfire for a while would be saying yes, they would. And the reason they would is because you could borrow up to the cash value right here, 106, and what they would do is they would subtract that 106 from the death benefit. So now your death benefit's 106,000 less. They just gave you part of your death benefit while you're living, and they collateralized it with your cash value. So what does that mean? Well, that means you get to use $106,000, but you're still earning interest and dividends on 115. So how much are interest and dividends? Depending on the company, but anywhere between 5 and 6% gross. So you're making 5 to 6%. Now, like you all said, 12 to 20. We had somebody else say 11%, but let's just use the lower one, 11%. You're making 11, and you're earning over here 5 to 6 on yours. So what's the differentiation? Well, the insurance company charges roughly about 5%, differs per company, but we'll just call it 5% for right here on the loan. So 11 minus 5, or let's go 5.5. We'll go right in the middle because I need just a solid number. 5.5 minus 5, you're ahead on both sides, right? Remember how I explained how a bank makes money? They pay you an interest rate on the deposit, and what do? They lend that money at a higher interest rate. You do a CD, they pay you interest on the CD, and what do? Lend it out at a higher rate. That's what banks do. And that's exactly what you're doing in this example. You are putting money into a vehicle that allows you to earn uninterrupted compounding interest. And while you're earning uninterrupted compounding interest, what you're also doing is you're allowed to use the money and make a spread. I don't care if you do 11 minus the 5 or you do the 5 minus what your policy is earning. So let's talk about that for a second. So the first year, if we did the 5 minus what the policy is earning, we actually lost money. Because remember, we lost, like, we're down, we'll round it up to 6% here, okay? We're losing money, or actually, I'm sorry, 8%. I'll do 8% because you got 92%. You got 8% you're losing, and now it's costing you 5%. That sucks, right? It sucks unless you really value the death benefit, but a lot of the folks we work with are like, I care about the cash value. But look at the second year. Second year, we deposit $15,000 into this contract. In the second year, we take out $16,212. Does anyone like the sound of that? It would be the same if you went into your bank and you gave your bank $15,000. You came back to that same bank and the bank gave you back $16,212. How many of you would like that? So you would love that, right? Now you go in the next day, you give them another $15,000 the next day, and then, or sorry, the next year, not next day, but you give them $15,000 the next year because it was so good the first year. And then what do they give you the next year? $17,000. So every single year you keep doing the same thing. You give the bank 15, the next year they give you 18, then they give you 19, then they give you 20,000, 21, and it just keeps on going. You would probably be very confused at how can the bank do this? Well, the answer is a bank can't do that and won't and never has ever in history. But who can do that is an insurance company, and you can be your own bank by doing this and changing where the money goes first, because the insurance company can do this, because now all the insurance company's doing is advancing some of the money that they set aside to pay when you die. They're making money on that at a rate of 5% because you're giving them 5% on the loan you took from the policy. But you care if you made 8.08% second year if you gave up 5? Some of you might. What if you made 14.7%? Would you care to give up 5? You might not care. 20, 27%, 35, 43, 63, 70, 78. I mean, listen, I'm only down to year 10. I went 10 years in, 78 minus 5%. Who cares? Someone on here would. But I'm just trying to make the point. Folks, listen, this is the only vehicle, the only place you could ever put money that can do this. And just so you all know, this internal growth that you're seeing here, it's all tax-free. Tax-free. As long as the policy is designed properly, which is how we design them, we always design them properly, this money's tax-free. So now, if you had a vehicle like this, if you had an account like this that did this, why would you ever keep the money sitting in the account if you knew you could take it out and still earn the same interest? Like, these numbers would not change at all if you took the money out as a loan. So every year you put 15 in, take 16 out, and you make that money to go to work at a higher rate. And every year you had more money than you did the year before. And every year when you made money, you didn't get a 1099 at the end of the year because you didn't have to pay tax on it. The only thing you had to deal with is this 5% or whatever the interest rate is that the insurance company is charging you, but this is simple interest. You're earning compounding interest, uninterrupted compounding interest, may I add. So you would always try to find a way to get more of this money into those single family homes, those notes, those forklifts, and all the parents' ranch and all those other investments that people were talking about. You would try to get as much money as you could out of the policy and into the investment, because now you would be making money twice. And in this case, which is not always going to be the case with every single policy we design, because this one, you know, this is a younger person. This is somebody who is 34 years old. So obviously that's going to factor into it just a little bit, but not a lot. If somebody was 50 years old or 60 years old, it's still going to make a ton of sense. A ton of sense. It might not be this good. Instead of year 2 being the break even from cash flow, it might be year 3. That's it. But this is what we do every single day. We help people set policies up like this. But you know what? We don't just help them set the policy up. What we also do is we help them manage the policy. We help them apply the policy to pay off debt, to buy cars, to invest on private money club, to buy forklifts, to use it for family ranches, all that stuff. Stephen, sometimes when I talk about this and I show this, I just don't understand why when somebody sees this, they don't immediately just be like, how do I do this? Where do I start? Because that's how I did it. I saw this. I was a financial advisor. I didn't think it was even possible. And as soon as I saw it, I'm like, I need to start. And I did. I just took action and got going. I didn't let other people get in my head. I didn't talk to other people about it except for my wife. I just did it. I knew I could go back and tell those folks and be like, hey, I told you so. You know, always be the leader. If you're always just the follower and always just the person who takes orders from everybody else, you're just conforming to what everybody else says. You're not actually creating anything. What we've done really well is create these pathways for our clients, and we share with you on these free webinars. So let's see. It's fear that there must be something that isn't being told. So Tess said that's the fear. There's something that's not being told. That's too good to be true. Great. I love hearing that. So how about this? When I hear that, it makes me just want to say, I told you so. So here we go. I'm actually going to do this, and I've done this before, but I think it's fun. See this? This is an old New York life policy. This is my policy statement. I started this policy in 2014. This is not my oldest one, but I didn't want to use my oldest one because sometimes people think it looks too good to be true. This is a normal, off-the-shelf, whole life insurance policy. Nothing like that one that I just showed you. But then I got one like I just showed you that I started on myself right here. Okay, this policy right here was started, what year did I start this bad boy? Put my glasses on and look at the policy date. 2022, January 26th of 2022. I put $1,250.10 a month into this policy. This one right here. This is designed the way I just showed you. So would it be okay if I just show you what my two policies have done so that I can kind of cover what Tess said, because I love that. The fear is there's something not being told to me. Okay, well, if you knew somebody, how do you eliminate fear? You research, right? You do your due diligence. So if somebody you knew, now I know I don't know all of you, but eventually, hopefully, you know, if things go the way I hope they will, I'll get to know all of you. You'll be at an event somewhere. We'll just get to know each other. You'll be around this campfire more and more. Actually, how many of you are brand new for the first time coming here? Just put I in the chat. Anyone here for the first time? Okay, Tammy's here for the first time. Welcome, Tammy. Who else? Just Tammy? You're the only one here? Okay, there we go. Karen, Joni, or is it Yanni or Joni? Doesn't matter. I got a couple of Finnish friends that pronounce it Yanni. Omar, awesome. So we got some people here for the first time. So listen, how would you decide whether something was too good to be true or something maybe was being held from you? You would try to find somebody you know, like, and trust, and you would try to get them to say, hey, I've done this, right? You try to find somebody that's doing this that you know. So that's what I'm going to do right here. I'm going to start with the old policy, right? The old whole life policy from New York Life, because this is nothing like what we would design for you. But I figure it's a good starting place. So here we go. All I'm going to do is I'm going to give you the numbers, just the raw numbers off my statement, and I'm happy to share this with any of you if you ask for it. Okay, so here we go. Now, let's just put things up here. I started this in 2014. That's 9 years ago. Crazy to think that 14 was 9 years ago. My premium was $570.21. See, I got this bird out here who's loving this stuff. That's how much money I was putting in. I didn't have a lot of money back then. Nothing like I do now. So that's all I was saving is $570. That's $6,466 a year. A very small policy. Okay. Now, the death benefit on this policy, for any of you that were kind of, because I know somebody would be like, well, how much was the death benefit? Well, it's $229,533. But here's the part that I think you're probably interested in. How much cash value do I have in this policy? Well, I have 56,070.56. So I've been doing this for 9 years with this policy, and this is how much cash value this policy has accumulated. $56,070.56. Now let's keep going. Right here, this is my year-end statement, December 1st, 2023. So this is a little old, but we'll just use this. The 2023 dividend was $1,000. So here's how much money I made. I made a dividend. Remember, how you make money in these policies is a guaranteed interest rate, which I'll get to in a second, but a guaranteed interest rate and dividends. So right there. The dividend in this policy this year was $1,644.69. Now let me go on and read you the next thing, which is actually even more exciting. During the past year, your base plan, which is the base, remember I showed you on the illustration a second ago, the base is the whole life, which in the policies we design now, we minimize the base and increase the paid up additions. There's no paid up additions in this policy. It's all base. Okay, so the base plan guaranteed cash value increase was $6,406.00. Okay, so that means my policy went from $40,600 to $47,006. In addition to this increase, your annual dividend was $1,644. So what I like about what New York Life does, not all the carriers do this, is New York Life is dissecting for you right on your statement. Here's your guaranteed interest, and here's your dividend. Separate, right? You're looking at them separate. And we can do this on every policy for any of our clients. We can tell them the difference between the two. But if we add that up, that works out to be $8,050.69. That's my total growth. Total growth. That is not how much I made though, because remember, I put in 6,000. So we got to subtract $6,466 because that's my premium. So I'm going to subtract the premium because it wouldn't be fair if we counted the premium in my total gain, would it? Now, a lot of people out there will do this. IULs, they do that. A lot of the people selling index universal lives, that's how they do it. They include the premium, but I'm not. I'm subtracting the premium because that's money you put into the policy. That's not your gain. So if we subtract those, that means I made a net gain of $1,584.69. Hardly anything to write home about, but actually it is something to write home about. because this is where I'm going to give you just a real quick lesson. I want to share with you how I do the math on these things. And this is how you probably do it on your investments, but it's also how you can do it on your safe money too. Why did I say safe money? Well, this policy is guaranteed to grow every single year. It can do nothing else but be worth more next year and the year after and the year after. It doesn't matter what happens with interest rates, doesn't matter what happens with world wars, doesn't matter what happens with inflation, doesn't matter what happens with anything, the markets, politics, nothing. It just is guaranteed to grow. So remember I said one of the most important things you need to start focusing on right now is preservation of your principal. But I did also say we still want to grow and have income. But what if we could have guaranteed protection and guaranteed growth? Wouldn't you be psyched about that? And what if you could get guaranteed protection and guaranteed growth with bond-like returns or better than bond returns? Because this policy, although it's 9 years old, if you were to figure out the return, here's all you do. You take $1,584. This is your net return. Why do I say net? Well, net of commissions, net of cost of insurance for that death benefit of well, actually the death benefit's more than that, but the death benefit of $229,533. So net of the cost for that, and net of the policy service fee, which New York Life charges $100 a year. So you take the net return and you divide it by your premium. So you take the premium 6,466 and divide it by the 1,584.69. Yeah, probably easier just to say it. Anyone do the math? What'd you come up with? Someone's got to have a calculator. Somebody's got to be interested in this enough. And I'll have Stephen kind of read some of these comments because I love it. And also, folks, while you're putting the chats in, can you put them over in the Q&A so that I can address them? What did anyone come up with? Anyone? Well, that is a 24.5% return. This is my return this year. I made 24.5% on the money I put in the policy this year. Remember earlier, I asked all of you how much you're getting on your investments. And I said investments intentionally because there's a difference between an investment and a whole life policy or an investment in a guaranteed account. And that is every investment involves risk. The one that probably would involve the least amount of risk would be that ranch, that family ranch that I can't remember who it was said that. I can go back up in the chat, or Stephen can when he gets back. So that family ranch, okay, that person that was putting money in, everything else involves risk. Forklifts are very low risk because you actually own the forklift. Loaning money on real estate, relatively lower risk because you've got the real estate as collateral if you did it properly with a mortgage. Okay, then notes, I mean, notes are pretty good. You got some collateral there as well, but they all involve risk. And none of them, if you remember, none of them said anything about a 24.5% return. If I recall, the returns were like 11%, 12%. I can't remember what the one with the forklifts, but 20% maybe. I made 24.5%. And the only part of that 24.5 that is not guaranteed is that dividend. But the one thing I know about dividends is these insurance companies, whether it's either one of these two, which I'm going to do the next one next, these have been around for hundreds of years, both of these companies. I think 160 years, 162 years on the one, and probably the same, probably 160 plus years for both of these two carriers. Every company we work with has been around longer than 140 years. And every one of the carriers that we work with, the insurance companies, which are all mutually owned, dividend-paying life insurance companies, every one of them have paid dividends each and every single year they have been open. Every single year, never missed one. Never. Those are good odds. Huh? So that's the only piece that's not guaranteed out of this entire thing. The 6406, that was guaranteed contractually, and I made 24.5%. Plus, if I die, my family has a $229,000 death benefit just on this one policy. This is the part where I start to explain there's nothing being hidden. Now, let me go one round further. Let's just say, is everybody's got these numbers? Let's just now focus on the total cash value. This is how much money I made. But now let me just ask somebody, see how well you are all paying attention. And I want to get this in the chats. Check how good you're paying attention. All right, so 5607, if I were to take $56,000 out, we're going to take $56,000 out, which is going to cost me 5%. And actually, right on the back of this, it tells me my loan interest rate, and it is 5%. So I can borrow the money from this company at 5% right now. So if I take all 56,000 out, it's going to cost me 5%. Let's say I go to privatemoneyclub.com and I lend that money out. And I lend it out at 12%. Okay? What is 12 minus 5? Can anyone do that for me? 12 minus 5, 7%, right? Is that what you're getting? There we go, Drew. 7%. So I make a net of 7%. But how much did I make? If I took 56,000 out and lent it out at 12%, and I net it, cost me 5, but I made 12, and I net 7%. Is that all I made? No. I made 7 plus 24.5. It's not this or that. It's this and that. Because how would most people lend money? Most people would lend money from a self-directed IRA. Maybe they'd lend money from a HELOC, which obviously, we know the math behind that. Or we'd lend money from a bank account. But if you lend money from a bank account, does the bank pay you interest on the money when you take it out to lend it? No. So you only make money once, right? 12%. So if you lent money from your bank account at 12%, you made 12%. But if you lent money from your policy and you netted out what the insurance company charges you, you made 7 plus the return of 24.5 in this example with my policy. Yours will be different. This is 9 years old. Nothing else can do that, folks. You're probably sick of me saying that, but I'm trying to really drive this home. And I'm going to go one more time now that you see the formula, and we're going to do this super fast. Stephen, could you check the chat and just go in and just let me know, like, is there anyone that had any questions on that? I just want to make sure everybody's got that. Some people were asking where the Q&A is. It's right down at the bottom. But here, now we're going to look at another policy. This policy, a different carrier, was started in 2022. So it's a newer policy. I put $1,250 and change a month into this policy. I have a death benefit. Where's the death benefit? Of $704,589 is my death benefit, but I got to die to get that, right? No. Okay. I put $1,250 a month into it. Now, if we were to, and I got to make sure I got the math right, that's $15,000 a year, give or take. I'm just going to use that. Now, here's the numbers. I'm going to give you 2023, and I'm going to give you 2024 because I have 2024's numbers. In 2023, my cash value in this policy was $84,488.25. My cash value in 2024 was $101,693.33, of which, let's see, I don't know if this company breaks. So not every company breaks everything down the same way. Here we go. My dividend this year from 2023 to 2024, my dividend worked out to be $2,231.07. Okay, so let's just do some quick math here. Let me grab my phone and do some math, and you guys can do this with me. So first off, let's figure out what the return or the total amount I grew by. 101,693.33. 2024's cash value. Then we're going to subtract that from 2023. And I'm happy to show anybody that has a policy how to do this on their statement. So that means we grew by 17,205.08. Out of that 17,000, 15,000 of it was premium. So we got to subtract the premium. And this is my gross increase, 17,000, but 15,000 of that was premium. So let's subtract that. Minus 15,000, that's $2,205.08. Okay? 2,205, if I did that right. 17,205 minus 15,000. Just double checking. There we go. Okay, now I'll come back over here. $2,205 is how much I grew. How much did I put in that year? 15. So if we take 2,205 and we divide it into 15, can anyone tell me what my return is? 14.7%. Net. This is net, and so is this. So now a policy that was just started in 2022, but it was designed to be used for the infinite banking concept. When we compare these two, can you see the difference? One took a lot longer to get there. This was 24.5. This one, 2 years after I started it, a little more than 2 years, but 2 years after I started it, is already at 14.7. And this policy, I had access to about 85% of my deposit that I put in immediately in the first 30 days. And this company, my loan interest rate is loan interest rate for prior policy year Next policy, 5.73%. So if I've got $101,000, I can take this money out and it's going to cost me 5.73%. That's how much they're going to charge me to borrow that. So if I'm making 14.7, I subtract 5.73, I can net it there, or I could just take this 101 and I could go out there and make 12, 15% and subtract 573. But you see the difference here? You're making money twice on the same dollar. All I wanted to do, folks, is show you 3 examples of how to preserve and protect your wealth, but how to also grow your wealth tax-free. Forget about lending the money out, forget about investing the money. Like, just what if somebody had a bunch of money? Like, let's say somebody on here exited their company and they got $50 million from an exit, hypothetically. Where are they going to put that money right now? Well, treasury bonds, treasury bills, money markets, maybe some CDs. All of those, the treasury bonds have some favorable tax treatment, but all the other ones are taxable. This allows you to grow tax-free, have access to the money, earn uninterrupted compound interest, and for crying out loud, protect your damn family. All in the wrapper of a stupid whole life insurance policy. So literally, like right there, I was able to show you how to take control of your money, the first one. But now let's go back real quick. I want to show you one other thing. I want to take just a quick pause and answer your questions. I opened up today talking about something everybody's familiar with, and many of you had, a home equity line of credit. I showed you how to build wealth through your own debts and expenses. I told you how to pay off all your credit cards and recycle and recapture the money, and I told you how much spread you make. Now, just imagine if we replace the home equity line of credit with one of these policies. The old New York Life policy, maybe it was this specially designed and engineered policy that I started in 2022. Imagine if we paid off all the debts with this. Way better, right? Because now whatever money I paid off debt, I used 100 grand in that last example. If I used 100 grand here and I made 14.7% net, whether the money's in there or not, which one would you rather pay off your debt with? The home equity line of credit, where all the interest goes to the bank, or your banking system where you keep all the interest and the only variable you have is this 5.73% that the insurance company charges you, which is a lot less than what a bank charges. So I'm going to pause right there. Stephen, let's hit some questions on that, because I just laid a lot on them. I really did.
Yeah, I was answering a few in the Q&A, but I left a couple to ask out loud because they're pretty good questions. Probably a lot of people have the same thoughts. So we'll hit this first one kind of piece by piece. It's asking, how soon can you start borrowing after initiating the policy?
So if we design your policy and we design it the way that I just showed you that second one was designed, you have access to your cash value immediately in the first 30 days. So let me just share. I want to just share my screen again. It's easier, I can talk all day long about it, but it's just easier if I just show it. So here was that one policy. This person put 115 in. They had access to 106, which was 92.32%. They would have access to, let's try to do the math. So I'll just do it simple. 6, 5, 4, 3, 2. So about 102. So about right here, your guaranteed cash value. They have access to about 102,000 immediately in the first 30 days when your check clears. And that's the numbers right there in front of you, because that green column are the guaranteed numbers. So all they include is the interest. So maybe it's 101 and change, give or take, but it's the first year, that's your worst year. It's a great question.
Yeah, and they're asking what's the percentage of policy you can borrow out. So that shows that right there. Now keep in mind, this is what we call a dump in, so a larger amount going in on top of the annual amount going in moving forward. So if we don't have that dump in like that, you might look at 60 to 70%, maybe 80%. So we can design it different ways.
Hang on. I might be able to show that. I have a ton of examples here, folks. I just pulled that one up just to show it. So, because actually you were asking about maybe 50 or 100. So let's do 50. I'm going to show you a $50,000. And actually, Stephen, I'm just going to do it right from the illustration because I don't feel like pulling one of those charts up. So we might have to do a little bit of math here, but here we go. And I think sometimes people like seeing the illustration. This is actually the illustration from the insurance company. So we can still get the same numbers. Same thing as I just showed you with the spreadsheet. This is just a little bit more difficult. So here's somebody that's putting 50,000 in and then 10,000 each year in this design. In the first 30 days, you have somewhere around 50 to 53,000 available. And then after that, over here, at the end of the first year, you have 55. 55,421 of the 60,000 you put in. The next year you put another 60 in and you have 59,590. So you can see this one takes 3 years, But in the third year, because of all the compounding, you put 10 in and now you got 13. That's like a 30% cash on cash return. If you did the math on that, if you put 10,000 in something and you take 13,220 out, I mean, listen, you guys can do the math, right? That's like a 30% cash on cash return. And the next year's more. And the next year's 14, and then 15, and then 16, and then 17. It's simple math when you're doing 10 grand. And then it just goes bonkers because now we're putting 9,000 in, we're getting 17. And then it goes even crazier in the 11th year. You got 3,000 bucks going in, you take 7,000 out. Listen, I think you all can do the math. That's over 100% cash on cash return. This isn't magic, folks. It's math. That's all it is. It's compounding interest. You've heard about it. Albert Einstein said it was the most, he said it called it the eighth wonder of the world. He said it's the most powerful thing in the financial world. Compounding interest. You're seeing it at work right here. But the only difference is to earn compound interest with how most people understand it, they got to put their money in something and leave it sit there. This is the only way you can put money somewhere, still use it, and still earn uninterrupted compounding interest. Is that helpful?
Yeah, absolutely. And then here's another good question. So this is old school thinking, right? So do you have to make a payment on what you borrow on top of the premium?
Yes. Yeah. So remember that interest that I said the insurance company charges? One was 5, the other one was 5.73. Every year at the end, well, on your policy anniversary is when it happens. It's not year over year. It's whenever you started. So remember, I started the one in January. So every January, I get a notice from the insurance company saying, hey, Chris, here's your premium deposit that's due. And I think it was what? Well, we used the second one, $15,000. Okay. And then here's the loan interest you owe on the loans you took out. But you see, that should not be an issue. And a lot of people get hung up here. So let me hit that from a different angle. I kind of just said it, but I'm going to say it a different way. People get really hung up on that. They're like, well, wait a second, I'm already making premium deposits. And in this case, your premium deposits in the third year are $10,000. Okay. So you're putting 10 grand in. And then if you take this cash value out, let's say you take all the cash value, 128,000 out, that money's out. You're going to owe interest on that 128. So let's just do the math on that. 128 times 0.05, 6,400 bucks is about what you're going to owe on interest that year. So you're going to get a bill for the interest on that. But you would never have taken the loan out if you didn't have somewhere for this 128 to go where it earns a higher interest rate. So if that was 5, what if you sent that money out to work at 10? Well, then just double the numbers. Now you're talking about 12,800. So anyone want to make 12,800 on their money? Of course they do. But you also still made the interest on this one. And what was the interest you made on this one? Well, you put 10 in and you took 13 out. So that's 30% cash on cash. So you can net it out anywhere you want. You can take the 5 from here or the 5 from here. Either way, it's the same thing. You're making money twice. That's the whole idea. So yes, you have to do that. But this money here, the 10,000, this is your savings. This interest that you pay, the $6,400 on a $128,000 loan, that money should already be out there earning enough to cover the interest. And if it's not, well, then we have to go back to the drawing board and teach you how this process works, because you never take a loan unless you have somewhere for that money to go where it's going to earn a higher velocity, a higher interest rate than what the cost of capital is. That's the rules of engagement. So you'd never take money out of this policy if you couldn't earn more than 5%. Great question.
So it says, so we'd have to get debts paid off to be able to invest $1,000 a month in the whole life policy.
No, nowhere did I say that. So you can use the policy to pay off your debts.
Right.
I just started with the home equity line of credit because that's familiar for a lot of people. So Tammy, actually, one thing I'd love to do for you, and this, I think this would be incredibly helpful, because I'm kind of going a little bit higher level with what we're doing. We have a video. Stephen, can you put the 90-day video or 90-day? Yeah, we got a 90-day video. You just watch it for 90 days. No, I'm just kidding. It's a 90-minute video. So Tammy, one of the things, copy and paste this. When you get some time later today or maybe in the evening, just watch this video. It'll just open your eyes. It'll really show you everything I've been showing you here, but I've missed some like entry level stuff. So for any of you that are brand new to this, I skipped over some of the like just fundamental stuff that we should have hit because I got a lot of people here that have already seen this that I'm trying to give value to, and a lot of people that haven't seen this yet. So I wanted to make sure you got the best value. Or I got another idea for you, Tammy. This weekend, or not this weekend, next weekend, we've got a 3-day Money School Essentials training. And that Money School Essentials training, we're going to be going deep into all of this stuff, but going into the basics on day one. Stephen, you want to just talk about that for 2 seconds?
Cool. Yeah. So the 3-day coming up next weekend, Friday, Saturday, Sunday, August 23rd, 24th, 25th. And This is the course that we've been teaching for about 4 years now, a few times a year, and we just update it depending on the economy, what's going on with the markets, what we're doing with our money, different investments, opportunities. So we invite people on to share with you, kind of A to Z, what it looks like to take back control of your money and start understanding how money really actually works, how the wealthy invest, how the wealthy look at money, different tax strategies, different ways of looking at retirement accounts, different opportunities outside of the stock market, what's going on right now this year with the elections coming up, with jobs dropping, with the market and very volatile, everything else that's going on. So we spend 3 full days with you, just basically walking through every step of that. And it's very powerful. It's a really strong starting point if you're just, beginning your kind of rabbit hole journey of learning, financial education like this, alternative investing. And so highly recommend it. We do charge for it. It is one of our very few paid courses that we do. Right now we do 6 webinars for free every single week. We put content on YouTube every single day almost, put stuff out on social media constantly. And that's all free, but occasionally we do have a paid event, whether it's in person or this virtual event. The only reason we do that is because we tried offering it for free one time, and guess what happened? Nobody showed up. For some reason, people, when they say believe things are free, it's that perception that there's no value there. So we said, hey, we'll charge a few $100 for this. Come spend 3 days with us. Ask all the questions you want. We're right there to help. We give you the recordings so you can watch it over and over again, keep it in the future. And then what we do is we give you some little bribes. So I don't know what you want to give away on this webinar, Chris, but we'll bribe you guys just because we understand how powerful this training is. We just want you there. That's all.
Is Dexter on here today? We got Dexter. So we got somebody, he's one of our clients. Why don't we give the decks away? Now, let me show everybody. So anybody that signs up today, we're still going to give you the $100 off, but why don't we give you the decks? This is what we call the decks. So this is it's a really nice, like wicking fabric, 3/4 zip or 1/4 zip. I mean, not 3/4 zip. I don't know why it does that, but that's what it looks like. It's got the logo right at the top. Really cute, pretty shirt. Works also men or women. So there you go. Got the 2 models showing it off. So we're happy to send you one of these. It only comes in black. So no options in color. You just got to tell us what size. These sell for $38 plus shipping. We'll just give it to you for free.
Cool.
And
all right. So I put the link over on the chat box on how to enroll for that course and give you $100 off, give you a Dexter, and be ready to rock and roll next week. Like I said, it is recorded and we send out the recordings at night. So if you can't make it Friday or you got a prior commitment for a couple hours Saturday or Sunday, not a big deal. It's fully recorded. We'll send that out to you. But we have some really, really cool new people coming on this 3-day too we've never had before. So I'm looking forward to it, Chris. I think it's gonna be a lot of fun.
Absolutely. No, I'm excited about it. They're always good. And this is a really important time right now with where we're at in the economy or where we're at in the economic cycle, election year, lots of stuff happening. I mean, listen, like we were doing WTF today, we're researching the Iran and Israel, and we could be days away from an attack there. Who knows? There's just so much going on, and it is time to literally get your finances in order before everything starts to fall apart. I know a lot of people love these free trainings, which is great. Like we do these every single week. Matter of fact, we do 6 live trainings every week. Every Tuesday at 1 o'clock, for any of you that want to see that 90-minute presentation that I gave to Tammy, every Tuesday we do that live at 1 o'clock. You can always get that. I know there's a link tree that we can put in there, gives you all the events we do for free, but this 3-day Money School Essential is always a paid event because we literally go all out. So you got 2 choices, the totally free ones, that's fine, always available, we're always doing them. And then you got the 3-day Money School Essentials, which is happening next weekend. It's all recorded. So we record all 3 days. We edit them down and timestamp them so that you can go in and just watch different segments, whatever you want to see, and get that way. But here is the only way you're going to get the Dex and the discount. So you get the Dexter and the discount by registering today. All right, so let's see. I covered a bunch right there. I want to hit, I got a HELOC already, funded my policy, and paid off all my debt via a loan from the policy. How does the segregated account, the HELOC, and the payment for my loan? Oh, I love that. Dude, great question. So now what we're doing is we've got somebody here who's, got a policy, did all this. So let me just kind of draw this for you just to make this easier. I want everybody to understand what's happening and what he did. So HELOC, okay, so they got a HELOC. Then they took, I assume, and correct me if I'm wrong, Rocio, I assume you took the HELOC funds and put it into the specially designed whole life, okay? And then over here you had debts. So just write, I'm gonna do it in red. You had debts over here. So you took the money from the whole life and you paid off the debts. Is that am I getting that right, Rocio? And you can put that in the chat. I just want to kind of have a dialogue with you here just so I get this right for everybody. Okay, perfect. So what they're asking here is we always teach everybody to set up a segregated bank account. And we do this for books and records, okay? But just not to over elaborate on the segregated bank account, it is literally a second checking account. So you go to your bank, your credit union, your community bank, and you open up a second checking account. It's that simple. But you don't get a debit card. You can get checks. It doesn't really make a difference. So what we're doing now, so we took the money from the HELOC, put it into the whole life. Took a loan from the whole life, which we talked about 5%. My other one was a little bit more, but I don't know, Rocio, I don't know what your loan is. Took the loan and deposited it into this segregated bank account. Okay, I'm just going to put this bank account just so I have room. And when the money went in there, Rocio, can I use numbers? Do you want me to use numbers or just put a dollar amount, any dollar amount? How about if you give me numbers, I'll put them on here. But let's just say it was 50K. So he took a loan, put the 50K in this bank account. Then what you probably did from there is either a bill pay or checks, and you paid off all of these debts. Okay, so we're getting rid of the debt, blasting the debt away. And folks, our team helps implement all this. We have this tool that Craig Yenny has created called the Debt Blaster that literally shows you how to do this in every step of the way. Right, Rocio, you used that, did you not? Did you use the Debt Blaster and the implementation team to do that? We help you do all this. So now once all these debts are paid off, 50 grand in debts, I don't know, let's just say simple math. Let's say these debts were costing $1,000 a month because I don't have numbers, so I'm just making stuff up as I go. What you would do is every debt that you used to pay, this 1,000 used to go to someone else. Now what you're going to do is you're going to take this 1,000 and you're going to deposit this 1,000 into the segregated account every month. So now let's just kind of recap.
They pulled out $47,000 to pay off debt.
Holy cow, that's awesome. I'm close enough, right? With 50 grand. Let's just make it 47. How much? Well, all right, since we're on a roll, let's use your numbers. 47,000. How much was the recapture? Like how much were you paying in all those debts? Let's actually get real numbers since we're doing this. I love doing it when I'm using real numbers. 47,000 in debt was paid off. Okay, so the loan from the policy was 47K. We paid off the debt, but how much money were all those debts costing you every single month? Okay,
Funded the policy was 60, and then they pulled out 47. That's really good.
That's awesome. It's like perfect mathematics. Close to 3K. Holy smokes. $3,000 a month is what they were paying to their debts. So this is freaking an awesome case study. As a matter of fact, can I offer this real quick? Rocio, if you're interested, and only if you're interested, I would love to have you on a Zoom, and I would love to do a case study for YouTube on what you did. If it's something you're interested in, just send Steven an email. Steven will shoot you his email real quick. I would love to do a Zoom on a real case study of how you did this, because this is awesome. Just think about this, folks. $47,000 was costing $3,000 a month. $3,000 a month was leaving the family forever. I don't know what the return was on that, but probably high. So now you've got this $3,000 a month coming back over to the segregated account every single month. So every month you're accumulating $3,000. So why do we do that? That's the recap. We borrowed 47, so now we know how much we took out, and we know how much we're paying interest on. So I'm just going to use 5%. I don't know what carrier we used for you, but this looks like maybe Lafayette, could be One America, times 0.05. 20. So this is where that person, this is going to kill two birds with one stone. That person was saying, this is a year, just so you all know, divided by 12, 195, 83. That's just the interest. So that person was saying, is the interest you got to pay to the insurance company above and beyond the premium deposits you're putting in the policy? Yes, but it doesn't matter because exactly what I'm about to show you. So the cost of this loan from the insurance company in this scenario is $195.83. We'll just do it by the year. Okay, $2,350. But we got to recapture in the course of a year, $3,000 a month times 12, $36,000. So in 1 year, this client is saving $36,000. So in every year, here's what's going to happen. 36,000 is going to get lessened by 2,350. How many of you would like to make $36,000 if it cost you 2,350 a year? Sign me up. I would do that every day of the week. But here's what Rocio was asking is, what is the process on how to do this? So we already paid off all the debts. We got the 3,000 coming back to the segregated account. The only reason we're doing this is books and records, because we don't want all of our banking money tied up with the rest of our household expense money. But here's the other thing I do. Now, this is taught differently, so I'm just going to tell you how I do this. What I always do is I set up a loan repayment, and our implementation team can do this for you. We'll do all the work for you. We'll set up a loan repayment for $3,000 a month, and that $3,000 a month is going to go to repay this $47,000 loan. But here's the best part. Repaying this $47,000 loan, what that means is Rocio gets $3,000 every single month to use. Again, you lose no liquidity here, zero. When you're recapturing this money, all $3,000 is accessible the next day because the insurance company charges you interest one time a year. So if you recapture all $3,000 into the whole life, what you could do is you could just, when you get the interest payment, call the insurance company and say, hey, can you pay the interest with the policy's cash value? I don't do it that way. I just write a check for it because there's tax advantages if you do it right. That's how I do it. But if you didn't want to mess with that, you could just have the cash value or the recaptured money just pay for this interest, because you just recaptured $36,000 in the year and you owe $2,350. You're doing pretty darn good. That thing's going to be a beast. Matter of fact, the only problem you're going to have with this is you're going to run out of room in this whole life policy for this recapture. So what's going to eventually happen, you're not going to be able to put, because you'll pay this loan off in no time at $3,000. I mean, just a smidgen over a year. A little over a year, you're going to repay this $47,000, but that doesn't mean that the $3,000 a month isn't going to keep coming in, because you were used to giving it away every single month. So just because you repay the loan to the policy doesn't mean you're going to stop recapturing the $3,000. So what'll happen then is over here in your segregated account, it'll start building up. So you'll start building up $36,000 a year, and then what you'll do is the same thing I did and every one of our other clients do. You'll start a second policy, a third policy, a fourth policy, but it won't be money from you working hard anymore. It'll be money from your money working for you that will fund future policies. That is a really amazing case study. Congratulations. What else we got? Oh, hold on, Deborah. I want to hit this one more time. Deborah had a great question. I totally missed this. Yeah, I mean, some of you are probably thinking, yeah, but Chris, hold on. There was a $60,000 home equity line of credit. You forgot about that. And I kind of did. I'm not going to lie, but it's okay. It's so easy. You got $3,000 coming in. What we would do is we would just maybe have 2,000 of this going back to the whole life, and then we would have 1,000 of it from the segregated account going back up here. Or we would figure the math out. The implementation team would figure the math out. Some of it would go to repay the HELOC or service the HELOC. The rest would go to repay the whole life. It doesn't matter. It's dollars and cents. So thank you for calling that out, Deborah. I got so excited about the case study. I'm like, oh my God, this is so awesome. But then remember I said to Rocio, I said, the only problem you're going to have is you're going to start having money build up in the segregated account in like just a smidgen over a year. It's going to take a little longer than that to start accumulating money here, because you're going to repay the HELOC. So in probably a year and a half, 2 years time frame, you're going to repay the loan to the whole life and repay the HELOC just out of money that you were giving away. So just remember, Rocio did not have to work any harder or any longer or take on any risk. This is money they were giving away. This money used to be given away to all the debts. It was gone forever. Now it's all back in their household, back in their family banking system. Love that. Love that. I literally, without that case study, I couldn't have done that any better. And we're gonna be hitting stuff like this heavily in the 3-day training, amongst a lot of other stuff. So remember, today's the only day you can register and get the decks, which is that quarter zip shirt and $100 off. Thanks, Deborah. I appreciate you catching that, Deborah. I would have felt like an idiot if I went back and watched this recording and I'm like, oh my God, I forgot about the HELOC. So you saved me on that one. What else? Anyone else got any questions or like a use case for me? We never finish early. I never cut this thing short. Never have, never will. plus tax right off the HELOC. Yes. So Frank, thank you for bringing that up. The one thing I didn't mention, because I'm not a CPA and I can't give tax advice, and nothing in this show or this webinar is financial advice. These are our opinions, and we can't give tax or legal advice, but you just nailed it. And if we had Jimmy on here, who's our CPA who shows up on all of them, he would definitely say yes, under most circumstances, the interest charged on the HELOC, which I didn't know what it was, or CEO didn't tell us, but if it was 7%, that's a tax write-off. Not always. I'm not a CPA. Check with your CPA or tax professional to make sure in your scenario you can do that. No, yeah, that was phenomenal. Hey, Tammy, listen, I do that all the time. I listen to things all the time in the car. I know it's kind of hard because you're listening and you're just not seeing the visuals, but Tammy, this video will be recorded. It is being recorded. We'll edit it and we'll put it up on my YouTube. So Tammy, when you get somewhere where you're stopped, just go to my YouTube channel and just make sure you're subscribed and click the little bell so that it notifies you when it goes up. And then you can go back and you go, oh yeah, I remember that case study with Rocio. Let me watch that. And you can just go through and watch what you want. We do that every single week. You know, listen, I'll give you a quick story while we're waiting for another question to come in. I don't remember what year it was, 2012, 2013, somewhere around there. I was in a tough financial place coming out of the Great Recession, sold my retail stores, was in a bind because I had a whole bunch of apartment buildings that were all getting renovated. So I was just in a really bad financial place. And I remember I got an invite to go to this mastermind. And this mastermind was like, I can't remember if it was, I think it was $5,000 back then. It was at this guy, Greg Reed's house. And I wanted to go, and he said, you got to be here. You know, the founder of Uggs is going to be here. The founder of Make-A-Wish is going to be here. You know, we got surgeons. And I'm thinking to myself, back then I was a financial advisor. I'm like, holy crap, I got to be in that room. All these people have money, and that's who I need to be talking to. Number one, I need to be seeing what are they doing different than me? And number two, I got to see if they need any financial advice. Because I was a financial advisor. I was like a trained hound dog for selling. That's all we were trained to do. So I went out there reluctantly because I didn't really have $5,000 to spend, plus airfare. I remember she was my fiance. No, was Larissa my wife then? I think she was. She was my wife then, or very shortly thereafter. But I remember she told me to do it because I wasn't going to do it. And I remember saying, I can't afford to stay where they're telling everybody else to stay because it was an expensive hotel. I'm like, find me the cheapest crap hole you can find and I'll stay in that. So I did. But the long story about this, the short part of this story is when I went to the event, I was really out of place. I just was like a fish out of water amongst the people. I didn't know what to talk to them about when they'd ask me, hey, what do you do? Do I tell them I'm a financial advisor? Do I tell them I'm a real estate investor? Do I tell them I'm both? Like I was having an identity crisis. So I remember I pulled Greg aside because I had just paid Greg $5,000. So I felt, hey, the best thing Greg can do is give me some good advice here. So I pull him aside and I literally remember telling him, I said, Greg, I need the best advice that you can give me. And I literally have a photo of right after this. I think I've showed this to Tess. And he leans into me, he puts his hand on my shoulder, and he says, Chris, I'm going to give you the best advice I can give anyone. And I'm like, yes, Greg, give me the best advice you can give me. And he says to me, he says, Chris, give your best stuff away for free. That was the best advice he could give me. And I got the photo coming up right here. Let's see. He said, give your best stuff away for free. You think that was the advice I was looking for at that moment? This is the photo taken right after that. See the look on my face? It's kind of a fake smile because I'm sitting here thinking, you son of a bitch, you just charged me $5,000 and I ask you one stinking question and you tell me to give it all away for free. Yeah, great, Greg, great. It was the best advice you could have ever given me because that's what we do every single week and every single day for that matter. We give our best stuff away for free. And like Steven said, we would do the 3-day event for free, but people don't value things they get for free. And that's another lesson. I mean, the most precious, valuable things in life are the things that are free. They really are. I mean, love, your relationships, your children. I know your kids aren't free, but the love for your kids is free. Those are the most valuable things. But what we value are the things we pay money for, the cars, the house, the clothes, the watches. We put value on things because we spend money on them. The money has something attached to us because we worked for that money. So therefore, when we give an exchange of that money, because that's all money is, a means of exchange, when we exchange that money for a thing, that thing has value to us. So when you exchange $197 to the money school to be part of the 3-day money school essentials, you will find value in that. Whether or not you watch the recordings or you actually are there live over the 3 days, you will have value because you spent your hard-earned money. But then we give you the decks. So you get the shirt in the mail and you're like, hey, at least I got this stupid shirt out of the deal if this training sucks. But Stephen didn't say one thing. If the training sucks, if you hate it, if you don't think you got anything out of it, we will gladly give you your $197 back. We will refund anyone that asks. We've never once had to refund a single person. But if you don't find value in the 3-day, we will give you your $197 back and you can keep the Dexter quarter zip cool microfiber shirt. Fair enough? So what do you got to lose? You got no money to really lose, because if you don't like it, we'll just give you your $197 back. You got a shirt to gain out of it, and you're going to learn a whole bunch of really cool stuff. But for some reason, when people go through the 3-day, they all find value. And you know what? Cost is only an issue in the absence of value. So if there's no absence of value, then the cost isn't an issue. And we've never once refunded money. So Stephen, put that link up there one more time. If anyone wants to sign up, we'd love to have you there and love to help you. Let me hit one last question here. Let's see. Does the annual deposit change as time progresses? I believe I saw this in one of the charts. Does the deposit get to 0? So let me pull the chart up because I think I know what you're talking about. All right. So when we design these policies, I'm just going to grab my little fancy pen here. Get that up there. So when we design these policies, we're going to design them with a minimum and a maximum. So let me just explain this. This particular client, the max they wanted to fund, like their desired savings, was $15,000. So we built a policy to hold $15,000. Now, you can't put any more money than that in. But we also built this policy to take a $100,000 one-time dump-in deposit. And these dump-ins we do all the time. Because, I mean, listen, if you got 100 grand sitting in a bank account, in a CD, in a money market, earning next to nothing, why wouldn't you put it into the policy where it's going to earn over 5%? I mean, it's silly not to even think about this. So we get a lot of people that are doing the dump-in. But the dump-in's not mandatory. It's optional. You tell us if you want to. This example just shows a dump-in. So 15,000 is the most, but the minimum is 6,000. So the minimum amount to run this policy design is $6,000. But that's actually not the minimum. So every single policy we design, every single policy, you could start putting 0 premiums in anytime after the 10th year. So anytime after year 10, this premium could go to 0. But you want to show me, can I show you why no one has ever done that? No one has ever, it's called an RPU, reduced paid up. Nobody has ever RPU'd a policy, not as long as I've been doing this, which has been about a decade. And here's why. If you put 6 grand in the 11th year, and you know you don't have to put anything, you could RPU it and put nothing in. But if you did have $6,000 you could put in, after you deposit the money, you would be able to take out $18,000 at the end of that year. Okay, so your dividend that year was $10,000. So you put $6,000 in, you could take 10 just in dividends, but you could take $18,000. So let me just ask anybody that can just do basic math. If you put $6,000 into something and you take $18,000 out, would you ever stop putting $6,000 in? No. You literally would have to go see a psychiatrist if you said, no, I don't think I want to put any deposits in. Matter of fact, if you don't want to put deposits in, how about this? I'll give you the $6,000. You put the 6 grand in and pay me the $18,000. You didn't want to put the money in anyway. So just give it to me. I'm kidding. But you see what I'm saying? Like, these policies are designed with a min and a max. And anytime during this 15,000, or the only thing that happens here, this 15 to 13,740, we drop the term insurance. So here we go from a $2 million death benefit, we drop the $1 million and change term, and we got $624,000. So we just get rid of the term. You don't have to, but that's what makes the policy more efficient. So you start making more money by doing it that way because you're not paying for the term insurance, because you don't need it anymore unless you want that death benefit. But you're not seeing it right here, but if I were to scroll down a little bit more, the death benefit starts climbing back up. See the death benefit? So the death benefit around the time when you're going to probably more than likely hit your life expectancy, the death benefit's where it was when the term dropped, 2 million. So that's why we don't typically keep the term insurance on any longer than required by the IRS rules. Was that helpful, folks? I know it was long-winded, but it was a great question. We got some really good questions coming in here. As long as I was making $18,000, well, that's the math right there. Here's the guaranteed cash value, so forget about that. How much are you making guaranteed? Shoot, I got to do the math because we didn't break it down, but here, I can do it for you real quick. So here's how much you're guaranteed without the dividend to make. So if it was 18,000 in the 11th year, 18,067, let's just say they didn't pay a dividend. I don't know, never happened, but subtract 10,738. They've never not paid a dividend, but let's just assume this year they don't. You'd still guaranteed interest, contractually guaranteed. You are guaranteed to make $7,329, guaranteed, which is more than the 6,000. And I still don't know anybody that wouldn't put 6,000 in to take $7,329 out. I don't know a single person that wouldn't do that. So you see what I'm saying? Like, when we get people that we're showing this, and I know a bunch of you are here for the first time, but when we show people this, they get super interested, but then they start talking to other folks, and the other folks start saying, it doesn't work that way. Oh, it's a scam. Oh, it's something missing. Like, I hope I did a decent job today of dissecting from my policies to this policy here for this person. I hope I did a decent job. Where'd my thing go? A decent job of showing you that I'm not trying to hide anything. I'm literally trying to show you more than you probably need, trying to give you more info than you even need, because I need you to understand this isn't my opinion or Steven's opinion or the money multiplier or BYOB's opinion. This is just mathematics. And the one certain in life is that math is the certain. People will lie, people tell stories, people over exaggerate things, but math doesn't lie. I showed you the math today. I literally broke down the math the same way you all could do it with your phone or your calculator. That's all we did. Simple 101 mathematics. This isn't algebra. This is anything complicated. This is just adding, subtracting, and division. That's it. Steven, anything else?
No, I think that's spot on, man.
And Frank, thanks for believing me, but you don't need to believe me, man. Just believe in yourself and believe math. That's all you need. Nobody needs to believe me anymore. We literally now, with how far we've come with the infinite banking concept, we can literally tell everybody, don't believe me at all. Don't believe me. I don't care if you believe me or not. Believe math. Just do your math. And we've created calculators and tools that just does the math. But I appreciate that, Frank. All right. Well, I hope to see a bunch of you for the 3-day Money School Essential, and I'll see a bunch of you this afternoon for the Ask Me Anything happy hour. I can only stay for a little bit. I've got a birthday party my wife's putting on over at my house for one of our family members, but I will be there, and the rest of the team will be there with their merry, merry, big smiles. Well, I don't know what I'm trying to say there, but yeah, bunch of smiles.
We'll have some fun.
We'll have some fun. Thanks, everybody, for joining us for this episode of the Wealth Webinar. Steven, thanks for being here.
Thank you.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.